Hi, and thanks for joining me. Another edition of Money Markets and New Age Investing. I'm Greg Weldon, your host, and I'm 40 years in this industry. I started on the exchange floor in the World Trade Center. I worked my way up as an institutional broker at Lehman. I was an institutional broker at Prudential. I met Louis Bacon there and got into the hedge fund world when he started More Capital Management, one of the most successful hedge funds on the planet. Certainly at the time was the place to be. Went on to be a trader for Commodity Corp until Goldman Sachs bought out the partnership there, and I decided to go off on my own. So I've been doing it on my own now for over 20 years. And what I found is in this business, especially as a trader and as, kind of a researcher, you got to put ego aside. And you're going to be wrong, a lot. And in the context of, doing what we do, it's not about opinion or, what you think should happen. It's about putting the pieces of the puzzle together, connecting the dots to create a picture that kind of defines where we are, and then theorizing where we might go. What is this scenario? What is that scenario? What is this scenario? What's the risk over here? What could happen here? And then kind of, playing out the fundamentals against the technicals and wanting everything to meld into one nice little picture. And even then, sometimes the trade is wrong because something could happen. And that's why I love to do this every day. It's new every single day. There's something new. In the context of what we're going to talk about today, it's the facts. It's the facts of the labor market we start with. All right. Just had the non-farm payroll report released a week ago. All right. Within that context, the labor force rose 736,000 people. What does that mean? Well, relative to population growth, which is less than 200,000, that means a lot of people came back into the labor force that hadn't been in the labor force, that had dropped out of the labor force because hearing that, the labor market is tight, or because forbearance and some of these things that the pandemic support was creating, a kind of a slice of the labor force that wasn't working, but still living off, the benefits of others, to the degree to which they come back into the market looking for a job because the job market's hot. Then they have to go back to work finally, right? Employment, out of 736,000 people that came back into the labor force, the number of people that found jobs, 222,000. Okay, the number of unemployed rose for the month by 514,000 people. So this headline gain of whatever it was, 180 some, whatever the headline number was, I don't remember because I really don't care. All right, because these are the real numbers here in terms of people coming back in the labor force. 70% of them could not find jobs. And the Fed is waiting for the employment dynamic, for the job market to loosen before it, stops hiking rates. I'd say it's loosened. And I would have said that before this number. And now this number really confirms it for me. Not only that, the number of employed rose 222,000. But within the details, you'll note that the number of people working part-time for economic reasons rose 221,000. Out of 222,000 people that got jobs, 221,000 of them got part-time jobs, and they were back to work, came back into the labor force for economic reasons. In other words, they're hurting. That's not a big vote of confidence in the economy. And with a Fed that is waiting for the most lagging indicator out there, employment, to turn before they turn. All right. Beyond that, to segue very quickly back to or into the Conference Board, which came out with their most recent survey of consumers, there was a 3.4 percentage point reversal from jobs easy to get to jobs hard to get. Start to put the pieces of the puzzle together. All right. So a lot more people are saying jobs are hard to get. Well, of course they are, because 70% of the people came back in the labor force couldn't find a job. Right. Within the JOLTS number from the BLS, which is lagged a month, keep that in mind. But nonetheless, the JOLTS, which is the jobs, the jobs available, the number of open jobs. But they also have a whole bunch of other statistics in there. I love dissecting these reports for this reason. You get the little pieces of the puzzle. Hiring fell by 167,000, and the current level of hiring for the month of July, because it's delayed a month for July, was the lowest in over 3 years. And the last time hiring was this low was in April of 2020 when the pandemic was going full blown out in knocking people out. Think about that. That's where we're at now. The hiring is as bad as it was at the worst part of the pandemic. Okay? Within the PCE numbers, personal consumption expenditures, we see spending, all right? Now, what was interesting is spending rose, like significantly, all right? In 2012 dollars, spending rose 0.6, nominally 0.8. In 2012 dollars, income fell by 0.2. So the PCE shows us that people expanded their spending, even though their income was flat or declining. And that has happened 3 out of the last 4 months. 3 of the last 4 months, people have spent more in terms of the growth and the percentages than their income has grown. All right. So when we break it down further, little pieces of the puzzle, within that context, spending rose $102.7 billion. Okay. And this was quote unquote from the, I believe this is the Commerce Department. I could be wrong about that. The spending increase was largely due to ample spending on insurance, housing, utilities, and healthcare. Necessities. So we go right to the base book from the Fed. What did the Fed say? Okay. Spending continued to slow, especially for non-essential items. Do we see where this is going? Consumers are now allocating their money to the fact that, essentials are becoming more expensive is sapping their spending on discretionary items. We've seen that in the retail sales number. I've been talking about this for months. When you talk about the monthly dollars spent and you talk about versus a year ago, and you talk about the 12 months in total, the only 2 discretionary sectors that have higher spending than a year ago, they're all in deflation except for online sales and eating and drinking establishments. And we can compare that directly to a decline in gasoline sales. And really it's about the amount of money less, because gasoline prices fell, the consumers had to spend at the gasoline station, the gas station, then that is a direct correlation to increases in online shopping and eating and drinking establishments. It's about 3 to 2. $3 saved at the gas pump, $2 goes to spending online shopping or eating and drinking establishments. The problem is that you see every other discretionary item, clothing, furniture, vehicles, garden and supply stores, material stores, Lowe's and Home Depot. Every other sector down. Okay, within that context, it's interesting to note, that spending versus income 3 out of 4 months. Those same 3 out of 4 months, savings declined. Savings declined. All right. So let's go back to the base book for a second from the Fed. Quote unquote. Consumers may have exhausted their savings and are relying more on borrowing to support spending. Unquote. We know this. I've talked about this. I've said this so many times. Savings is back to before. It's lower than it was before the pandemic. It's lower than it was in 2019. All right. Credit card and consumer credit overall have reached a record high, and the growth rate is gone parabolic. So that's really interesting to me in terms of how you see this play out in terms of the economy and the consumer that everyone on TV says is healthy. The consumer's not healthy, especially, at the lower income scale. But that too is changing, and we'll talk about that in a second. But there's something else going on here, right? And it is another support besides having dwindled savings, besides borrowing more. Wages, we know, are already deflating on a real basis. The second you get your paycheck, by the time you cash it, it's worth less. It's going to buy you less. The other support is the government. Within the PCE data, we see that transfer payments rose at an annual rate of $4.05 trillion. These numbers are huge. They've been huge for a long time. All right, they were as high as $6 trillion during the pandemic. They've come off. They were down into the 3.6, 3.8 area, and they've come back up. $4 trillion a year in transfer payments. What are transfer payments? They're handouts. But they're also entitlements. It's Medicare, Medicaid, Social Security, but it's welfare, social support programs. which are, ever larger, especially with, illegal immigrants. And I mean, just some of the stuff that's going on in New York City. I mean, it's insanity, man. Tell me they haven't lost control already. I mean, they have. I mean, as much as they try and tighten their grip on control, they're losing control. It's obvious, and especially in the places where these are the policies. I did a Labor Day special live on the labor market, but a lot of what I'm telling you right now is in that special. But what's really interesting is there are two charts in particular, and I put them on Twitter, so you can find them on Twitter. It's in our in a macro market minute, which is on YouTube, user/Gregory Weldon. You can certainly get a copy of it. I'd be happy to send it to you for free. Sales. Don't be afraid by that word. We're not very pushy at all. At weldononline.com, one word, Weldon Online. But the charts are really interesting because I chart consumer credit, transfer payments, and savings together. And they're very correlated until recently. Savings has collapsed. Okay? Then I take another chart where I take real disposable income versus transfer payments. How much of disposable income is coming from the government for people? Okay? Well, the real disposable income has led transfer payments since 1971. I track everything back to when Nixon closed the gold window, took the dollar off the gold standard, right? Because that's really when this credit bubble started, right? I'm not a gold standard guy. You can never go back to the gold standard. Gold would have to be priced at $70,000 an ounce just to cover a portion of broad money, all right? But when we look at the disposable income versus transfer payments, what's the government handing out versus what are people actually earning on their own? All right, widening differential in favor of people earning on their own. Real disposable income was outperforming government handouts for 38 years until 2009. And when QE started, everything has changed. And since then, you see everything from credit to the balance sheet of the Fed to the U.S. debt has exploded. That includes transfer payments. All right, it's been a narrowing trend since 2009 until the pandemic. And another 8 trillion printed and 6 trillion in year over year transfer payments. Since then, disposable income and transfer payments are moving lockstep together. The correlation is so tight you think it's the same dang thing. Different scales, yes, but the percentage is way up, and the degree to which it is now really kind of people are dependent. To some degree, there's people dependent on transfer payments in their entire income. And we just can't keep printing money and spending money and handing out money. It's insane. Look at what's going on in New York. I mean, oh my God, who the heck would want to live in New York City now? I mean, and all these high-priced apartments around Central Park, can be overlooking a refugee camp, for crying out loud. What kind of view is that? What happens to prices there? I don't know, but that's a side point. But it's no wonder then that when we get back to the conference board, the family financial situation question shows a big differential from used to be we think we're healthier now financially versus we're not healthy. Okay. The differential between good financial situation and bad financial situation in April, it was a positive 10% difference. Now it's positive 2%. And the number of percentage of good, people saying their financial situation is good has declined rapidly, and the percentage of people saying their financial situation is bad has risen rapidly. The last time it crossed over, of course, was during the pandemic, and it's close to crossing again. Okay. Within that context, it's interesting to note the expectations index from the conference board. What is the situation going to be like? And bottom line is the conference board said, quote unquote, the expectations index has reached a recession threshold. The differential, expected versus current conditions, is the worst it's been outside of 2000, 2008, and 2020. It is a precursor to a recession every single time. Every single time. Within that context, the income expectations, people expecting their income to go down jumped big, and people expecting their income to rise fell. And that differential closed to a real narrow gap, which is really, really a negative going forward. How is this supposed to work? And by the way, one of the reasons, too, that people were less comfortable about their future financial situation as well, all right, because the one-year inflation expectation rose to 5.8 from 5.7. And not only that, But the people at the conference board, they have a really good chief economist, I forget her name, but also mentioned, by the way, that what's interesting is that confidence is eroding as it has been, especially for the people that make under $50,000 a year. Well, how can you even live on that much money nowadays when the government prints money like it's going out of style? All right. But also for the people earning above 100,000, the highest income people are now feeling the pinch, the squeeze. That hasn't been the case this entire time. You've noted the difference between the haves and the have-nots. And the haves also have the advantage of home equity, which has exploded. I mean, it's trillions and trillions of dollars. So home equity loans, the only source of credit that is growing. But that's really, again, for the very few that own $1 million homes that are now worth them, 1.6, 1.8, 2 million. Insanity going amok. All right. But at 5.8% inflation expectation, that's not anchored. The Fed keeps saying inflation expectations are anchored. They're not. They're out of control. You have El Nino, which we'll talk about again in a minute, but you also have an interesting report from the logistics managers survey. Logistics, remember that? I mean, how important that was during the pandemic? Okay, you couldn't get supplies of anything. All right. Well, of course, everything's eased, and we see it in the Fed surveys. We see it in the ISM survey. We see it everywhere, that things have kind of gotten back to normal. They're not normal. There's things I still can't find in the grocery store. I'm sorry. And the percentage of people that say they come out of the grocery store, a recent survey, I saw this, I forget who the source was, but it was on Bloomberg, that said 71% of consumers coming out of a grocery store say they can't find things they wanted to buy. 71%. All right. Within the logistics manager survey that was just released this week, prices have turned to the upside after being down for months. The transportation price index is up 4 months in a row now, and the highest since February. So think about that in terms of truckers and in terms of, again, the incremental cost every step of the way of goods that are purchased in this country, where they made, then they're shipped, and every step of the way. Not only that, but because backlogs have been worked off. So the backlogs of orders is the thing that's kind of kept the economy going beyond the kind of maybe crossing over the event horizon into a recession. But the orders also slowing, inventories are rising now. And what's interesting is inventory cost index has risen 2 months in a row. It's up 21% in 2 months. Think about that for companies. Their inventory costs just went up by 21% in 2 months. That's not good for margins. That's not good for the stock market. None of this is good for stocks, by the way, until the Fed starts printing more money. And inventory costs the highest since February. Then we turn to trade numbers also released real quickly because essentially it kind of ties it all together. All right. Actually, let's get to housing first because we haven't even talked about housing. All right. MBA, the Mortgage Bankers Association, the mortgage rate came down in the latest week, but the purchase index fell and reached its lowest level since 1996. Applications for loans for new home purchases, the lowest since the 1990s. The refi fell again. It's near the January low, and the January low was the lowest since the 1980s. All right, so the housing market's collapsed. I mean, labor is now rolling over. But let's look at trade for a second because it kind of ties the U.S. situation together and takes us to our next little phase of today's podcast. Trade is also delayed a month, so it's July numbers. Imports rose. The deficit and exports fell, and thus the deficit increased to $65 billion. That is what prior to the pandemic would have been a record. Would have been a record deficit. Okay, the budget deficit, they're talking about $2 trillion. It's going to be higher. I can tell you that just by the projection of the numbers month to month. I mean, it's going to be higher unless there's a miracle in revenue somewhere, and that ain't happening. All right, but say the budget is $2 trillion, and savings rate is as low as it's been in a long time. Does this not sound familiar? Twin tower deficits, and a savings rate that's too low, and consumer that is living on credit as prices rise. The only difference here is prices are rising. The last time all this was the case, you didn't have inflation really. You had oil prices up, but that was a one-off. This is a different animal, man, because prices are up on everything, and you're going to have prices of food going up because of El Nino. We're going to get to that right now. But you also have this whole dynamic around logistics, and also that ties into El Nino, as per the Panama Canal, as I've discussed. So what do we do in this environment that, frankly, where I think the stock market is just really, it's as extended as it's ever been, and without a couple new $1 trillion of money printing, or a dollar that is in decline to a double-digit rate year over year, which is far from the case right now. Dollar's breaking out to the upside because people keep pricing the Fed funds futures now to actually odds that they hike again this year, which had not existed 2 weeks, 3 weeks ago. So what do? We play the inflation. We play the inflation coming from energy. We've talked about the base effect. I've told you where gasoline prices were a year ago and where they are now, and you're going from a 20% discount to a 20% premium. And that's going to impact the inflation number starting now. Food prices are going nuts. I mean, sugar's at a new high. Cocoa's at a new high. Beef is at a new high. OJ's at a new high. That's just in the futures markets that I trade. And we're long in most of those, not beef. We kind of missed that. It's the thin market. But energy has been the call. We have been making this call. We've been dead on right. We were dead on right in Infotech earlier in the year, and we switched at the right time, whatever. I mean, Infotech hasn't made new highs since then. It hasn't also fallen either, but we switched to our allocations to energy. In our ETF playbook, which is really about the stocks too. It's the S&P 500. We break down every stock. We rank every stock in every sector, and then use the S&P sector indexes, index ETFs, to kind of create portfolios, along with the discretionary portfolio that I just judge by myself. That includes currency ETFs, bond ETFs, commodity ETFs, metal ETFs, energy ETFs. The other portfolios we offer in the playbook are quantitatively selected, and depending on what your risk metrics might be, we have a couple of them. But right now, the allocations on a quantitative basis, energy 33%, Infotech 33%. Energy has risen to the level of Infotech, okay, which is interesting. Within the overall market, though, only 28% of the S&P 500 stocks are in a bullish trend, and 27% are in a bearish trend. That's a 1% margin. This is like the most narrow breadth of any market that's almost at new highs with 0% year-over-year rate of change. So it's kind of interesting. In the discretionary part of that portfolio, and by the way, in Infotech, just to give you a preview of what we just did in our playbook, what we do every week, I mean, the hottest new breakout is old school goes new school, IBM. IBM breaking out, just like GE did several weeks ago that we caught as well on the podcast here. But discretionary is 30% energy as well. But that also includes uranium. All right. But what do we break it down? Well, let's look at crude oil first. Crude oil, in terms of U.S. inventories, and I've told you, go back to the previous podcast, about the supply-demand situation, about Saudi Arabia holding off enough daily production that would balance this market instantly. All right. People are worried about, we get a recession, demand will go down, and that's going to be negative for crude. Not necessarily, because the daily deficit, supply deficit, is 2.5 to 3 million barrels a day. And so you'd have to have GDP fall by 4% to even really impact the demand side enough just to balance the crude oil market, let alone put it into a surplus situation. That's not happening, because the fourth quarter is the most tight quarter that we've seen in a long time in terms of the demand rising for factors other than just economic activity. Seasonal factors work into it. We look at U.S. inventories, okay, which are down already because, to the degree to which Biden dumped 40% of the strategic petroleum reserve to keep prices below 80. And where are they now? They're 85. So thanks. You just dumped half our strategic supply. You're playing right into China's hands. It's just insane. Insane energy policy by this administration. I'm sorry. I don't like to get political, and I don't really support either side in a lot of things. All right. I can criticize both sides. All right. But because it's facts, and the facts are this: crude oil inventories in the U.S. down 3 weeks in a row. Down 6 out of the last 7 weeks, down 9 out of the last 11 weeks. The decline over the last 11 weeks is 55 million barrels. That's more than 10%. All right, you're talking about supply that's around 420 million barrels. We came from 480 million barrels to 425 million barrels. All right, in the last 5 weeks alone, you're down 40 million barrels. It's almost 10 million barrels a week. Think about that going forward. Within a year, you'd have no energy. You'd have no crude oil supply left. Now, of course, that's a dramatization. That's not going to happen, but that is the numbers. All right. You are right at the 2022 low and not far away from the 5-year low in crude oil inventories in this country. All right. You have a 2.5 million barrel per day global deficit. In other words, demand at 103 million is above output, which is, anywhere from, depending on what you want to use, 1 to 101.5. So the deficit is anywhere from 1.1.5 really to 3. We peg it around 2.5. 2.5, and that runs through the end of the fourth quarter. So let's just say, to be conservative, 105 days, that's 260 million barrel decline in global inventories. Think about that. Crude oil would be $125 a barrel, and I think that's where it's going. I really do. The XLE is the crude oil S&P index, sector index. It's at a new high for the move, 92.05 on a closing basis. The previous high was in January, $1 away. The previous high to that was 2020, $1 away. So you get above 93.11, you're at the highest level since 2014 in the energy sector from the S&P. What are the best stocks? I love the gasoline stocks and always do. Hess, Phillips 66 made like a new mini high here too. And ExxonMobil are the top three. Chevron and Valero pulling up the rear. Chevron's always the top pick, but it's underperformed. And all of a sudden it's breaking out too. Uranium. We talked about uranium in the last podcast. I believe we did anyway. You're talking about China, Russia and Kazakhstan control most of the world's supply of uranium, yeah. And Russia is the number one enricher of uranium. All right. So they hold half the supply when there are over 300 new plants globally planned in the planning stages, because it's more green than fuel. So we can't get electric fast enough. With solar and wind is not as efficient. Uranium is the most efficient. Nuclear is the most efficient energy by far. It's not even close. Solar and wind are at the bottom. All right. So when you consider that, the URA is the uranium ETF. We recommended it a while ago. It made a new high this week. It got up to $25. $24.92, I think, rather, was the high. It closed off a little bit, but still, at new highs for this move, even on a closing basis. $24.92. It's just $4 away from the April 22 high, which also takes you to $31.60 is the November 2021 high. And beyond that, it's the high since 2014. Okay. Cameco, all right, $37.88. It's a big producer out of Canada. And Canada's a pretty big producer. We get 30% of our imports come from Canada. Okay. But we also have 12% of our imports come from Russia. So we're sending arms. We're spending money to send arms to Ukraine. In the meantime, we're buying we're buying the uranium from Russia and giving them money too. It's like, come on, man. The irony and the hypocrisy and the insanity just doesn't get any better than this for podcast guys like me, man, or for, analysts like me to just kind of make fun of them. But it's not funny at all. It's not funny at all. All right. You're not far away that the Cameco, I always want to say Cameco, 37.88 is the March 2011 high. You're not that far away. And beyond that, you're like at a 12-year high here. URNM is uranium miners from Sprott. Anything Sprott is credible to the max. So if you want to get involved in the miners, that's not a bad play either. It's been one of the better performers out of the whole sector as well. And to touch upon, before we go out here, just two other things, all right? When we talk about El Nino, all right, the logistics manager report mentioned the Panama Canal. There's not enough water. So ships carry less stuff because they can't be as deep into the water if they're too heavy, right? India has now completely blocked exports of rice and sugar, right? All the Asian countries are now bitching about this, like, oh, India, we rely on your rice. It's like, we got to feed our own people. It's interesting to see how, immediately the Asian nations start throwing barbs at India because they're not providing food to them because they got to feed their own people, all right? Rice, I've said this before, and I believe this to be true from all the research I've done. 50% of the world relies on rice for 80% of their food. Rice is at the highest level in price since 2011. This is a real issue. You're talking about coming up here, too. What could be other impacts from El Nino besides all the stuff that's going on in countries like Chile that are cutting interest rates because of El Nino, or in Peru where you can't get ceviche because the farms have been destroyed by the heat? All right, the Rhine River, lowest water levels, right? So that means a lot of shipments in Europe, go through the Rhine, especially even stuff like natural gas from Russia, all right? One of the El Nino effects would be a very cold winter in the EU. Natural gas, energy, all of these things, right? The bottom line is we do this every day, and I, really enjoy what I do. So thank God. But if you want to, find out more of my work or see some of the charts that we talk about, plenty of places to see them. We have In a Macro Market Minute, which is 60-second videos every day on the most updated news, macro markets, whatever it might be. It's on YouTube. It's YouTube /user/Gregory Weldon, GREGORY Weldon, WELDON. You, of course, can follow the podcast on Twitter at money_podcast. You can also check out me on Twitter, and a lot of these charts show up on Twitter sometimes, at Weldon Live. And then if you want a copy of the Labor Day special with all those cool charts on transfers and income and all that stuff, it's a really good one. I called it the best live I feel I've done all year. I'd be happy to give it to you for free. Just email me at sales@weldononline.com. weldononline.com. Thanks for joining. Till next time.